Hey, welcome back, everybody. It's John. It's time for a general market update. It's June 16th, 2023. Reminder, this is a presentation by Rain King LLC, and I'm an amateur individual growth stock investor. So the agenda today is we'll talk briefly about the indices, then we'll cover the breadth of the market, then we'll do a little bit more discussion about the pullback and what specifically I'll be looking for. And then we're going to talk about how do you stalk the leading stocks and a quick wrap up. So let's start with the indices. So this is actually the NASDAQ and the S&P. The NASDAQ here on a weekly basis, this is really constructive. We've had 8 weeks up in a row on this rally that we've had since May. So it's a really positive sign right now. The S&P, which has been a little bit weaker than the NASDAQ, has also had logged 5 weeks up in a row. So that's constructive. You can see it's really starting to move out right now. Now, I know there's been a lot of talk about the breadth. We're watching it carefully. I put a chart of the weekly chart of the RSP, which is the equal weight S&P index. You can see that it's definitely still lagging a bit, but it's starting to catch up. We've had 2-3 weeks in a row with some good closes and some good volume. So this issue about the breadth, we talked about it last week. We were seeing signs that it may be slightly improving. I put out a tweet this week about I thought the NASDAQ was stretched and going to pull back in, and I got a few comments. So I just wanted to show a really simple rule that I use, kind of a hack. What I do is I actually measure the distance. The green line on this chart is the 9 EMA and the pink is the 20 EMA. If the distance between the closing price and the 9, in this case, yesterday it was 2.7%, if that distance is more than the gap between the 9 and the 20, which was 2.3% yesterday, then I consider, the NASDAQ to signal that it's really stretched. And historically, when we have seen this signal, it generally means a pullback is going to start the next 1 to 3 days. So it's just a little hack that I use, fairly simple. I do not use it on individual stocks. I just use it really on the index, particularly the NASDAQ, and it's held true to form over the years. Not perfect, but it works pretty well. So let's get into this market breadth. 1 week ago, this was the chart we were looking at for the New York Stock Exchange advanced decline line, and we said this was an improvement, but we still had some hurdles. We still had to get through this peak in April, as well as maybe getting back to the February highs. So what does the chart look like today? So here's the exact same chart. You can see we've made more improvement this week. We've actually taken out the April highs on the advanced decline line, which is really positive. The upper panel shows the S&P getting to some 52-week highs. But the important thing is we want to see this breadth continue. We really like to see take out the February high in the advanced decline line. Here's the New York Stock Exchange net new highs minus new lows. And we've seen the improvement in the last couple of weeks. We've been netting out new highs, much more in fashion with a market that's trying to move higher. I've drawn this red dotted line across at the 50 level. What I would like to see is when we get the pullback, I'd like to see that the net new highs stay above 50. And if you look at this on a broader chart, generally pullbacks and strong uptrends will stay above 50 on the net new highs. So I'm going to be looking at that when we get into the pullback. Here's the S&P, the percent above the 200-day moving average as of yesterday. Again, we've seen this really strong move from late May, early June. Strong move up. We're now up to 65% above the 200-day, much more in line with a market that's trying to move higher. We still have the peaks from February, which were up around 70 to 77%. So we want to see this continue to prove to us that the broad market is strengthening. Now, switching just to the NASDAQ, this is actually just the NASDAQ new highs only. And so I just wanted to show you the trend. If we looked at just the new highs in the NASDAQ since May, you can see we're getting a steady increase in the new highs. and it's actually exceeded the February new high. The peak there in early February was 199 new highs on the NASDAQ. A couple of days ago, we had 233 new highs. So it's good to see that we're actually stocks are making highs and then continuing to make highs as other stocks break out. So that's really, really positive. Now let's talk a little bit more about the pullback. So anticipating this pullback, we're trying to understand if the uptrend is really for real. And I've constantly said we're going to learn a lot more on the pullback than we do about the rally. June tends to be weak in the second half of the month. So last week we talked about we were starting to see some improvement. I won't go over these. You can pause your video player. But we really, really want to x-ray into this pullback when it happens. We want to look at some of the real leaders and see how they act. And the group that I'm watching is NVIDIA, Supermicro, Acellus, Rambus, Tesla. Those are the real big movers, really strong. Kind of in the mid-range, you've got Celsius, Mongo, Palo Alto, HubSpot, and some of the smaller new names we have are IoT, INTA, DV, and AI. We want to keep looking at breakouts. Are breakouts continuing to get some follow through? Are they holding up? So we want to look at that. The depth of the pullback into support levels. We want to look on the chart, see what makes our logical support levels. How deep is this pullback going to be? Anywhere from 1 to 5% would be completely normal, given the leg that we've had that we're going through right now. We'll start to show this on a chart in a moment. And I mentioned ideally, I want to see the net new highs stay above 50 on the pullback. So this is last week, and I showed the S&P, and we were looking at pullback levels. So I won't go over this again. It's in last week's video, but I'm going to go to the next chart, which was looking at the levels on the NASDAQ. So here's the NASDAQ. We've made this very, very strong push led by the Qs and some of the real large tech companies. So I've just put a couple of levels here that we can monitor. The first one is a kind of a garden variety 3% pullback. That would take us down to the 13,127 level, which basically coincides with this purple line, which is the 20 EMA. If we go a little further, I drew a line at an 8% pullback, which is 12,680. I put this in the color of pink. I'd get a little concerned if we came all the way at an 8% pullback. I really think that's borderline, but it could happen. And then if we came all the way back down to this resistance level that it took so long to get through, that would be almost an 11% pullback to the 12,270 area. I don't think that would be a good sign at all that the entire move up gets retraced. That would really give us concerns that maybe this rally was a fake out. But we certainly hope the breadth improves and things hold up much better than that. But again, we want to monitor as it goes. In the bottom panel, these are new highs, new lows, and I've just drawn this 50 line across the chart. So this is the line I'm going to be looking back. When we pull back in the index at some point, I really would like to see it above 50. We'll see what happens. If it goes below 50 by a little, I'm not going to get too concerned. But if we turn around and start making new lows and we get a complete dry up in the new highs, that would be really concerning. So stalking the leaders. Now, it's important to know, we've gone through this bear market, and this has lasted for a long time. We're probably 18 months or so into this bear market, which is transitioning to an up leg. Now, bear markets can condition us to be very skeptical, very hesitant, and even cynical. When you go through taking losses and you get caught up in a lot of whipsaw action and bear market rallies, you could start to lose confidence in your own trading system. And that really weighs on you during bear markets. We want to try and stay really engaged. We've emphasized staying to your routine, follow your daily and weekly routine, stay engaged with the market because the markets can change quickly. We want to stay positive and ready to act when we need to. And it really, the market environment has been changing. So it's really a mindset shift. The environment might be starting to lend itself to longer time frames. So we want to be open to that and let the market lead us to what's the best action. Now we know that leaders lead. they show their hands first, they break out first, and they start to run. And last week we talked about the leading groups, and that was semiconductors, the hardware, software, internet content, home builders. Now you should have some sort of toehold in these names if you've been paying attention with your watch list, and you're probably building some cushion, and you're going to need that cushion when we have the pullback. Now you might ask, maybe you don't. Maybe you missed all the big leaders and you are not on top of it. So what do you do now? And you may ask, who are the leading stocks? So this is where you really, really have to exercise patience. You have to be disciplined and you have to stalk the leaders. Now, I really avoid taking too many second-tier stocks. If the leaders have run and their stock's starting to break out now, they're probably not as strong as the true leaders. And they usually won't outperform them either. So you might take a name or two out of the second tier, but I wouldn't load a portfolio with those. I would rather focus on finding a way into the leaders. Now, avoid chasing the extended stocks. No FOMO. There's plenty of time to get in the big leaders, even if you miss them. So don't have FOMO. Don't chase extended stocks. Now, the market is extended. We talked about maybe there's a pullback coming. We don't know when. We don't know how far, but we just need to be observant of what's happening. So who are the leaders? Well, by definition, stocks that move up the fastest and pull back the least, those are the leaders. We want to see institutional quality names, ones that have good fund sponsorship. We want to see some liquidity. They should have at least 500,000 shares a day trading, or you could use a screen of an average daily dollar volume of at least 10 million, like to see 20 million or more. I prefer to see the leading stocks that are making new highs or at least within 20% of 52-week highs. Those are preferred versus stocks that are deep in their basing structures. Now, we've had some moves in Palantir and Zscaler and Bill Holdings, but they're pretty deep in their basing structures, so you want to look at that carefully for overhead resistance. You want stocks that have good stories, new products, services, following a really good theme in the market. This is just a basket of ones that I would consider to be the leaders. NVIDIA is probably the #1 leader in the market right now. Rambus, Axcelis are strong. You could even throw Tesla and Meta and Netflix in there. Supermicro could be in there. Kind of some mid-level size companies would include HubSpot, Mongo, Palantir, Palo Alto, Celsius. And then I've got a couple of more younger companies, more newer companies to the market: IoT, DOCN, DV, Live Nation, and Duolingo. And we continue to see strength in the housing stocks. There's many of them really, really acting well. These are probably 3 of the strongest. So this is a chart I tweeted out. This is actually Bill's trade of Amgen. And the reason I put it out there was 2 reasons. One, I wanted to show all his buys and sells to show you how he was scaling in and out of the position. But most importantly, as it relates to what we're talking about with leading stocks, is Bill, actually caught Amgen on a stage 2 base. He missed the initial double bottom, but he still waited, was patient, found a way to get into a leading stock. He bought it out of the 8-week cup and still had a 550% gain. So you don't have to chase stocks if they're extended. Wait for a proper entry. And here's another one of Bill's. This is Research in Motion. This is the full chart. And you can see in this particular chart, Bill did not catch the first cup with handle or even the stage 2 flat base. He didn't pick this up on his screening until it was a high tight flag, really the 3rd basing structure, which he picked it up here and he got a nice move out of it. So again, I'm trying to emphasize for you that if you missed the initial surge, you're still going to be okay, even if you pick up a stage 2 base. Now, if you really are interested to hear more and hear Bill's actual analysis of this, go to my Twitter feed, and I've got a GMU extra in there with Bill's analysis of RIM. So how can we get into a leader? Well, we need to wait for a pullback. One way is to wait for a pullback all the way down on a weekly basis to the 10-week moving average. Another way we could do it is simply just wait for the stock to form a complete new base. And don't forget, a flat base can be as short as 5 weeks. And another option is to be very observant. As we pull back, some stocks might create shakeouts. And in my GMU Extra from last week, I broke down shakeouts and told you what to look for to see something as a constructive shakeout versus something that is rolling over and you should get out. So that's something you might want to take a look at. Pullbacks, pullbacks you can use to enter stocks. I think you have to have a very specific plan, though. You don't go into this willy-nilly. I think you should have a plan on how do I enter daily pullbacks in stocks and how do I enter weekly pullbacks in stocks. And you should have some rules of what you're looking for and how you enter. It's not a guessing game. You should have a strategy. Now, the mindset is important with pullbacks. You really have to ask yourself, are you wired to buy strength or buy weakness? Because buying pullbacks is buying weakness. I can tell you from my story, I've always been a buyer of strength. And it's only been in the last 2 or 3 years that I've forced myself to develop daily and weekly pullback setups and start to be more comfortable with buying on weakness to get into leading stocks. So it's something that didn't come natural to me, but other people, pullbacks are their number one strategy. So you need to know your own mindset and your own psychology. Adding to positions, watch your average cost carefully. Just because you missed a leader, if you miss NVIDIA and it pulls back a little bit, don't plunge in all your position at one time just because you want to get into the leader. You still need to manage your risk carefully, and you should probably be scaling in incrementally. If it's a completely a new base, then you might take your standard position size. But if you're using an incremental process of a daily pullback, 3 weeks tight, a pullback into a moving average line, you're probably going to want to scale it because you don't know how the pullback will go. So be very cognizant of your average cost. You can mess up a good position by raising that cost too much. So in a summary, we've kind of covered it already. The breadth's improved on this Fed pause we got this week. The NASDAQ is stretched. We're going to watch this pullback when it happens, and we're going to evaluate it very carefully to see if it's constructive or if it's something that really concerns us. As I mentioned, if we get a correction of 8 to 12%, bringing us back in the NASDAQ to the previous resistance area, that'd be a negative in the short term. Might mean we're going to have to go sideways for a while. I think exposure levels could be increased gradually as we're making progress, depending on your level of aggression. I think 35 to 55 is a decent place to be. I know some of you will be much more aggressive than that, and other people will be more conservative, but you need to do what's right for you, and emphasizing don't chase extended stocks. It's all about having confidence in what you're doing and having conviction. Ask yourself this question: do you own stocks because you're bullish, or are you bullish because you own stocks? So it's Livermore, and more Livermore. Last week, we had the first lecture, volume 1, and we're going to get a double dose of Livermore next week. Next Tuesday will be volume 2, and on Thursday, we'll have volume 3. Things get really interesting in the story. If you haven't signed up, reach out to me at Rain King Bull Bear, and we'll see if we can get you in the group. We'd love to see you there. Well, that's the general market update for June 16th, 2023. Have a great weekend, everybody, and we'll see you all next week on the next general market update.